Hello guys, hope you and your families are doing well. Jack Corsellis here, going to be teaching you how I trade the Minervini low pivot. So this is going to be centered around four main elements of a low pivot. Number one, we've got the trade identification. Number two, we've got the initial controlling a risk. Number three, we've got the risk mitigation where I'm looking to free roll the trade. Then number four, we have the sell rules, which is focused around optimizing the trade, both thinking about monetary and percentage gain, but also the efficiency of said gain. We're going to be going through TRADINGVIEW, which is one of my model book stocks. So a lot of exciting things coming for you guys next year on the new platform, model book stocks, all of that good stuff. So we're going to be looking at TRADINGVIEW. MarketSmith are the sponsor of this video. There's a discounted trial available in the comments below if you are interested. Okay guys, TRADINGVIEW loaded up. Now there's four main elements that I'm going to be focusing on, and we're going to be going through them in order. So we're going to be looking at the trade identification, then we're going to be talking about the initial controlling risk, then we're going to be talking about the risk mitigation element, and then we're going to be talking about sell rules and optimizing profits. Now there's a bit of a nuance here with TRADINGVIEW because earnings were reported after the close. So this is something that you can see, that you get these nice VCP cup and handle flag type patterns that are tightening up, creating the pivot point, and then earnings comes out and it powers through a pivot point. So a little bit of a nuance here, but let's just wind back a little bit and start talking about the trade identification. So first and foremost, we can see that TRADINGVIEW is in the context of a nice uptrend. You can see all of these moving averages are trending up. At the time when the pivot is actually being created, the stock has closed above all of those key moving averages, consolidating nicely around the 1021 EMA, which is a nice reference point to look for trigger bars, which I'll talk about when we start dialing in over on the pivot. Just doing a little bit more of a bird's eye view currently. Nice bounce on the 50. We'll be talking about that. But TRADINGVIEW is also a leader. Now this is a free tool that you can use to search my name on the TradingView indicators. You'll find it, Jack Corsellis RS line. I like to look for stocks that are hitting 52-week highs, and I really like it when a stock powers out of a base, so a VCP in this instance, and it then gets a 52-week blue dot there, so a 52-week high on the relative strength line. Really good. I like trading those kind of breakouts. Something else to be thinking about now, this is a real nuance when you're thinking about the trade identification, is just looking back at the stock over the last year, couple of years, 3 years, maybe even 5 years if you want to, and see, is the stock a good trading stock? Does it kind of set up the patterns that you are looking for, whether that be flags, low pivots, high pivots, cup and handles, Darvis boxes, and just see, is the stock a good trading stock? Does it trend nicely? Does it set up nice and tight? Does it create some nice asymmetric risk versus reward trades? So for whatever reason, some stocks are very choppy, very difficult to trade. You see that a lot with the commodity stocks. So you can see here, this isn't necessarily tradable because of the base duration, but see how tight it gets in here. Really nice flag type pattern there, a little bit short on the base duration, but still a pretty good setup. Here you get a low pivot forming around the 1021 EMA. See how it dries up there. Now this rally from this breakout here, the stock goes up around about 80% in the space of a week or so. So the stock on the face of it looks to be a fairly good trading stock here. It builds nice bases, powers high, a bit of a clean mover. So nice, we like that. Now we have this larger base setting up. So the cause and effect relationship here, we find supportive action on the 50 SMA in here. We bounce, we come back down, we get this bearish candlestick, but then we then we get an immediate reversal bar coming through, undercut. So this is a bar that kind of gaps down marginally below the 50 SMA, closes tight, and then we're tight here. See how the volume then stair steps down, and then we put in what I call a trigger bar. So trigger bar is a very tight range bar. There's actually a trigger bar in the preceding days as well, but a nice tight range bar in here. Nice reference point. See how this volume has just been stair stepping down from left to right. It's nice, subtle high low coming in this most recent contraction relative to the first one in latest July, we could say, and then that bounce there in early-ish August. So nice. So then the question becomes, we have this nice kind of VCP setting up. Now the question becomes, we're still on the identification part, where exactly do we want to buy it? Now the vast majority of my entries will be buy stop limit orders with the stop loss attached. That's how I like to buy it. If you like to buy it differently, absolutely fine. I'm just explaining in this video how I trade these low pivots. So I will use a buy stop limit order. That's much more the kind of Weinstein approach, the Darvis approach as well. So we have this kind of pivot forming here. So 26.63 is kind of the high of these last 5 bars. That is where supply is drying up. So we're looking for these areas where price gets really tight, nice little sideways drift. You want to avoid the ones that are kind of wedging up. So just kind of a case in point here. You see here, yes, we're tightening up here, but you see how the context is different. You've probably heard this concept before, wedging up. See how it's just kind of wedging up here into a breaker. Ideally, you want to get the ones that are sideways to down. So you see here, this is kind of sideways to down. See in here, see how this is sideways to down. These are better rather than those wedging up ones like this. So ideally you want to get that kind of sideways to down. If visually it helps you, think about trying to identify a mini Darvis box. That's what I kind of do visually. I ideally want to see kind of a mini Darvis box, or kind of just a mini kind of flag to the downside. See this, how it's just sloping down. It's subtle, something you'll train your eyes to. So we could be looking at the high, these last 5 bars, which is kind of a mini Darvis box, or we could be looking at at the high at the final bar. Now, for me, earnings came out after the close on this day here. I didn't trade this one back in 2004, but then it's interesting because earnings are coming out. So you've got this nice accumulation base. The stock is a leader. So ideally, what do we want to see on the earnings? We just want to see the stock moving through the pivot point and then just powering up to an extent where we could mitigate risk on the trade very quickly and then see if a large trend can unfold. So for me, I would actually be using the high of this bar here. Now, the logical place for my stop loss would ideally be underneath the 50 SMA. However, that is much wider, and this is going to happen on the more volatile stocks as well. So ideally, you'd like to be around here. However, that's way too much risk going in there with an initial stop of 12-ish%. I would say if you're swing trading around VCP breakouts, flag breakouts, cup and handles, all of that good stuff, if you're swing trading, you're primarily using the daily chart, your average stop loss is probably going to be in the range of 3% to 7% on average is what I would say. So that is kind of ballpark what I'd be looking for. So if I go stop loss underneath the low of this bar here, underneath the low of the final day, that's going to get me closer to about 6%. Because remember, this is earnings. I just want to see it go very, very quickly. It's tightened up, supply stopped coming to the market. So a stop loss below the low of the final day, that trigger bar is going to be around about 6%. So okay, we're identifying it, and the identifying it obviously then leads into the controlling risk. Can we create an asymmetric risk versus reward trade? Now we want to start thinking about the risk mitigation element. What on earth is that? That is where I'm looking to free roll the trade. So when I'm targeting a lower pivot in the base, I'm looking left. I'm seeing, are there logical places within the base? And it may be from overhead supply, it may just be a recent high where price may stall out, and it may just be more psychological than anything. So the first part which gets my attention is over here, the 29th of July and also the 30th of July. So if we just put a level across there, I'm just going to make this green. So around about 29.70. So what I'm thinking is, this looks like how this base has kind of formed. This looks like a logical area where price may be stalling out. And if I just kind of do this in, say, a red zone in here, something like this in here, okay, a bit of overhead supply, or this kind of orange zone, bit of overhead supply. So, okay, can I look to free roll into that? Now, it's going to be hard for me to push my stop loss up because I'm already on the low of the trigger bar. So what I'm going to do is take a reading. Now, ideally, I want this to be around about 2 times my initial stop loss, and a move into the high there. I'm just going to say it's 11%. So the risk mitigation element, this is very difficult to learn. It takes a long time. It takes you to actually be kind of dynamic and fluid in your thinking, which a lot of people struggle with. So my initial stop is going to be 6%. What I am then doing is thinking, into this 29.70 area, that may be a level where I'm looking to free roll. So the free rolling levels, if you want to free roll by selling half of your position, you need a 1R move of wherever your stop loss is. That may be your initial stop loss or where your new stop loss is if you pushed it up. If you want to sell 1/3, then you need 2 times wherever your stop loss is. And if you want to sell 1/4 of your position, you need a 3R move wherever your stop loss is. So what I'm doing here in terms of planning the trade out, now I would then use a sell limit order. So in this instance here, I'm going to have a sell limit order for 1/3 of my position just underneath 29.70. So what I'm going to do is a 1/3 sell limit order, and this is going to be, let's say it's 29.67, okay, like this. Now, what I've then got to do to make sure I've completely mitigated the risk, and it's already kind of pretty darn close here, is, does it sound plausible? Because this is an 11.5%. If we divide that by 2, we get to 5.5%. Does it sound plausible that if price hits 29.67 and I sell 1/3 of my position, that I could push my stop loss from where it is there at around about 6% to 5.5%? Sounds plausible, doesn't it? Why? Because then if price comes back down to that 5.5% level and I get stopped out in the remaining 2/3 of the position, I'm break even on the trade. So the stock has done no damage to me. So this is very active here in terms of risk mitigation, okay? Active risk mitigation early on in the trade. Sun Tzu quote, I'm trying to position myself beyond the possibility of defeat, I would add, as soon as prudently possible. So let's play this forward. So I'm looking to buy it here at 26.47. I may have a limit that is saying within 0.5% of the pivot point. Let's just play it forward, and hopefully you guys will kind of start understanding this. So what we've done on this first day here is we've actually entered, so we've got our entry, plus we've sold 1/3 with a sell limit order at 29.67, and then what we've done is we've just pushed our stop loss up to around about here. Let's just say, I want to make this video a bit quicker, okay, to around about here. Now I'm just going to delete that so the chart is a little bit cleaner. So hopefully that there is making sense for how early on in a position I'm looking to identify the type of orders I do, how I'm then thinking about the risk mitigation. Am I looking to sell 1/3? Am I looking to sell 1/2? Where are the logical places where price may be stalling within a base? It's getting out really well on earnings, good volume coming through, 52-week high. Now what I will try and do, we're now moving into the fourth part. So we've got identify, we've got control, we've got mitigate, and then we've got optimize. So we're trying to optimize profits both in terms of monetary gain percentage move, but also the efficiency of said move as well. But early on in the trade, I'm expecting some form of test at the pivot point. So I am looking looking for a pop and I'm trying to sell into that first pop where I can mitigate the risk, and then trying to sit through the testing action and then play the stock for the bigger intermediate term trend, and we'll get on to some of the sell rules. So what I'm looking for here is a potential testing action. So see how we're testing, and then this here for me is actually the reversal bar. So sometimes it will come back down, test, and you'll be stopped out. Sometimes it'll test for a couple of days, reverse higher. Sometimes it will test for a week, test for a couple of weeks, test for, it'd be rare for it to kind of test for a month, but you can have this. So what I'm looking for is a testing action and then a reversal bar. Now when I get the reversal bar, that there is invariably the trigger for me to be pushing my stop loss on the remaining parts of my position to break even or above. It depends how the stock plays out. You've got to be very dynamic, very fluid in your thinking here. So it now doesn't make any sense for me to have my stop loss down here at 5.5% because we now have a gain of around about 45%. So what I am going to do is move this one up, just like this here, so somewhere in between the pivot point and these lows here. Now I am using the black line and the blue line to help me make high quality decisions. That's going to be, the black line is the 10 EMA, the blue line is going to be the 21 EMA. So ideally I am trying to ride those and then sell 1/3 on a close below the 10 EMA and 1/3 on a close below the blue line, which is the 21 EMA. Now I am not a short-term trader, I am an intermediate term trend follower. So these sell rules are very applicable for me. They may not be applicable for you, which is absolutely fine. What I also do is if I think on a short-term basis price starts to get extended, I will choke off maybe with all the position or part of the position by going lower the day, lower the day, lower the day. So just an example over here, imagine if you bought this, okay, and you started thinking on this day here, well, price is really extended, I should just sell everything. Well, in my view, that is not an optimal way to just kind of guess that the stock is extended, I need to sell everything, especially if you've been in a harder market and suddenly you get a good gain on the stock of maybe 20%, 30%, and you just want to snatch it very quickly. Well, if you snatched at a 20-30% gain and then it went up another couple 100%, that's really silly in my view. So I'm trying to capture the intermediate term trend. If you're short term nature, absolutely fine, I don't care, you're watching my video, I'm going to tell you how I manage these positions. So you can see here, lower the day, lower the day, lower the day, lower the day, like that. So then you'd get stopped out there. Here as well, if you thought it started getting extended here, lower the day. If you started thinking get it extended up here, lower the day, lower the day, lower the day. That there is a much more effective strategy that I employ. Now clearly if it's ridiculously climactic, massive volume, maybe I'll think about taking some off towards the close, but it really depends. I don't want to go too much into the weeds. So I'm now just going to play this forward. Okay, so I'm using my stop loss kind of as a catastrophic stop loss. And what I'm going to do, I'm just going to play this forward a little bit. So we bounce on the 10 EMA. So I'm just going to do this, and I want to just illustrate a couple of points. This here would have been a really good ad. I was a little bit quick. I wanted to actually add on this video, but you see how it tightens up here? That there could be a potential ad through the high of this bar. See how volume just steps down here again? Trigger bar. These are trigger bars. See where it's sitting in relation to the moving averages? These are trigger bars. I could have added through there if I was a little bit quicker. But anyway, it's another test reversal. So I'm just bringing up my stop loss behind it, just like this, okay? And I'm trying to ride that intermediate term trend. Now, what you guys are going to find is you're going to have stocks that hopefully are going to be trending well. Again, this is kind of market environment dependent. It's also stock dependent, obviously. In a healthy breakout environment where the indexes are trending up, you are going to have these longer term trends play out for these stocks. However, in even the best of stocks, you are going to have bearish days. So pay very close attention to the day after a bearish day. Now you want to see one of two things. You want to see either a bullish reversal bar like this, or a bullish absorption bar. So this here, bullish reversal bar, this is bullish absorption bar. This is a bullish reversal bar. So you just want to be aware and something to be looking out for. In my experience, the best of the best stocks, when they break out from these VCPs, these couple of handles, these flags, and they start trending higher, they are going to have bearish days which may not violate your sell rules, and it can potentially shake you out of positions unnecessarily. I will try and give the stock a little motto I have in my head, assuming I don't think any sell rules are violated, so on and so forth. I will say to myself, one more day, because it can just shake you out of a very big winning stock. So be on the lookout for these bullish reversal days or bullish absorption days very soon after you see a bearish candlestick. Now what I'm going to do is just continue to play this forward, and here, this here is called a change of character. This is the exit right there for me. That's the exit on the remaining 2/3 of the position. Now had it just sliced through the 10 EMA, I would still have 1/3 left. I would have sold a third, but here it slices through both of them. Now you also want to be aware of this, that stocks are not going to trend up forever. You're going to have these change of character bars, and this indicates to me the end of the intermediate term trend. So it's slicing through the 1021 EMA here. Note where price is opening. Opens on the high of that bar, closes on the low, and you see how the volume pops up. This is a change of character indicating that supply is becoming dominant. Now another another nuance and a subtlety. Do you see how here the stock was actually tightening up beforehand? See how it was tightening up? There's a bit of Davis box action going on. So this is telling you that there's a balancing act. When you see these multiple tight candlesticks, volume drying up here, nice sideways action along the moving averages, this is indicating that there is a balancing act here between supply and demand. There isn't much supply coming to the market, there isn't much demand coming to the market. So then we want to be aware of which way does price go, because that's going to signal to us either demand is the dominant force or supply is the dominant force. So on a bar like this where we get this bearish change of character, this is clearly indicating supply is the dominant force. When we tightened up here and then we break out to the upside, this is indicating demand is the dominant force. So this here is the end of the intermediate term trend. This is what I'm trying to capture. That. Now, I never know whether that is going to be 5%, 50%, hundreds of percent, or whether I'm going to get stopped out within a couple of days. I have no idea. It is the nature of the beast. But this is indicating to me, okay, there's a change of character on a minimum. I'm expecting a new base to build out, so I can always buy the stock stop back if it sets up another VCP or a cup and handle or a flag or a Davis box or whatever. But it's indicating, as you can kind of see over here, it's indicating there's been a changing of character. You can see it over here as well, changing of character. I'm at least expecting a base to play out, and I can always add back. I can always initiate a new position. Then when we play this forward, that there is then very, very efficient. Then you see over here, see how it resets. 1 contraction, 2 contraction, 3 contraction. This is then kind of a higher base breakout. See how the volume just stair steps there. It just happens time and time again. Then breakout 52-week high. So this here, this is what I'm trying to capture, the intermediate term trend. That is what I'm trying to do to the best of my ability, and try and get in those stocks that go up 5%, 50%, not 5%, sorry, 50%, hundreds of percent. Try and capture those big intermediate term trends and try and sit. Livermore quote, traders who can buy right and sit tight are very, very, very uncommon. It's really difficult to try and sit in these intermediate term trends and just allow them to play out. But be on the lookout for these change of character bars, 10 EMA, 21 EMA, and then slicing through them, bearish change of character. That invariably means the end of the intermediate term trend in my experience. So that's it, guys. I'll wrap it up there. Hopefully you found that video useful in terms of how I trade Minervini low pivots, in terms of identifying, controlling risk mitigation. Hopefully really interesting there for you, and then also optimizing the profits with various errors. So thank you very much for watching, and I'll see you in the next one.